Boy, there's been a lot of economic news over the last week that are going to affect our property markets. So in this week's Property Insider Chat, Dr. Andrew Wilson and I discuss the latest Australian Bureau of Statistics figures showing that over COVID, our property markets grew more than they did in the previous decade. We're going to discuss unemployment, immigration figures, what the rising interest rates in the United States are going to mean for Australia, plus lots more. So if you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel. Click the little bell icon so we can update you every time a new show comes out. It's been another interesting week in property and our economic markets. Recently, the Australian Bureau of Statistics told us that residential property prices rose 23.7% in 2021 last year, meaning the collective value of the wealth of property owners increased by $2 trillion in just 1 year alone. In fact, the growth in wealth over the past 2 years is higher than all the gains over the decade before. However, at the same time, unfortunately, we've got the continuation of the war in Russia and Ukraine, and that's continued creating ongoing concerns about global inflation, which meant that over the last week, the United States Federal Reserve pulled the trigger and started raising interest rates, pumping up pressure on our Reserve Bank and Philip Lowe to follow the lead in the fight against inflation. However, in Australia, we also had the best jobless numbers in 14 years, again creating more speculation about rising interest rates. So to discuss all these factors on our economy and our property markets, I'm looking forward to my regular weekly chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market.
Yes, good day, Michael. It does seem a bit like Groundhog Day again in terms of interest rates, but it's always significant fuel for those breathlessly predicting higher interest rates. And of course, with rates rising now in the US for the first time since 2018, there's the usual and highly predictable follow-on from the media and those looking for a cheap headline that we will follow almost immediately, or at the very worst or very least, whichever, that our mortgage rates will rise because of the funding differentials now between US banks and Australia. And of course, that's complete nonsense. And we know that it's nonsense when we look at the historical reaction in terms of funding costs and how they manifest themselves into mortgage rates in Australia when there are changes in US rates, and it doesn't have any impact at all.
The Australian Bureau of Statistics told us that the value of residential properties in Australia is now getting close to $10 trillion after growing at the fastest annual pace on record. It said residential property values rose 23.7% through 2021, meaning that homeowners and property investors collectively increased their net worth by $2 trillion in just the 1 year alone. But putting this into perspective, this figure is 30% larger than the annual output of Australia's entire economy. Now, this is a staggering rise in household wealth. It's really hard to fathom the extent to which housing wealth has increased during the pandemic. At the beginning of the pandemic, according to the Australian Bureau of Statistics, all of Australia's residential real estate was valued at $7.1 trillion. To put it another way, the growth of our wealth in the last 2 years was higher than in the previous decade. And interestingly, despite all the property pessimists and negative Nellies out there over the last couple of years, each week we've been continuously explaining the strength and the stability and the robustness of Australia's property markets.
Well, yes, and lower interest rates will do that to you every time, Michael. And of course, that's the secret. We had a duality of falling interest rates. First, we had the back end of 2019, 3 cuts to rates, which picked up a flat market then because the Reserve Bank finally changed its mantra from the next move will be up to realising our economy certainly needed stimulus in that period, middle of 2019. Of course, that activated housing markets that had been flat for the previous 18 months. And then, of course, along came COVID. And again, we needed to stimulate our economy, and interest rates fell down to the lowest levels on record. So no surprise, of course, that affordability skyrocketed with those low interest rates, and house prices followed upwards as a result. Now, the big picture is that whether we're measuring house prices or the value of houses, that we still have quite certainly a robust housing market with any sign of stress in terms of mortgage defaults or arrears just non-existent at the moment.
Well, that's one of the things that some of the bank economists are predicting. We're going to fall into mortgage arrears if interest rates go up. We're going to get onto the mortgage story in just a moment. But I think we should also explain that This was unusual. It was a once in a generational boom. And moving forward, our property markets are going to be more fragmented. That's a more normal market, isn't it?
We've run out of steam, Michael. That's the point. The interest rate genie is back in the bottle. And even if we do get rises, they will be incremental and they will be covered by incomes growth. The Reserve Bank's adamant about the fact that it won't raise rates until incomes are growing again. So obviously higher rates will be absorbed by higher incomes. And that's the point. We're not on the roller coaster anymore. We're off the roller coaster. And that means the future for house prices is certainly flatter, but more predictable. And I think that's what we're all looking towards, Michael, a predictable and more certain outlook for house prices. We've run through these, you said, in strongest growth in a generation. Well, we've come through all these unique experiences in terms of our economic cycles and our housing market cycle, house price cycle. And now we're hopefully moving into a much more certain environment because we don't have that built up energy to be released.
Well, of course, one of the reasons property values could drop is if people lose their jobs and can't afford to keep up their mortgage payments. But that's unlikely with the latest February data showing very strong figures, unemployment falling to 4%, and that's equal to the lowest in history going way back to 1978. Employment was strong. Participation rates are lifting. That's all good news for our economy, Andrew.
No surprise there, Michael. We're recovering from the issues earlier this year, which certainly sidelined some of the workforce with COVID. And now we've got that 4% unemployment rate. Still some underlying issues to look at there. New South Wales participation rate is still down on where it was at its peak last year. So that's, and the New South Wales unemployment rate is under 4% now, but that doesn't account for those workers still to come back into the workforce. But of course, the secret to our low unemployment rate, and it shouldn't be a secret, and it's not a secret, is the fact that we've stopped migration over the past 2 years. If we look at the growth in the workforce 2018 to 2020, Michael, the workforce increased by 3.7% over that 2-year period to February. And if we look at the 2-year period to February this year, the workforce has only increased by 1.7%. And that's a shortfall of around about 270,000 workers, Michael. So you could imagine where we would be if we had those extra 270,000 workers competing for jobs. I think that certainly the unemployment rate would be higher. And of course, along with the labour market data last week, the ABS released its population data for the September quarter, the latest data, and that reinforces what I've just said then about the impact of migration. We can see that in the 18 months to the September quarter 2021, we actually had a fall of around about 118,000 in terms of net international migration. So we actually lost 120,000 people, Michael, over that period, that 18-month period from June 20 to September 21, whereas in the previous period prior to that, we actually had an increase of 368,000 in terms of international migrants. So you take one from the other and you get the difference in the workforce, Michael. And that's what certainly kept our unemployment rate lower. But we need to, I guess, focus on the outlook, which is for mass migration to be reintroduced into this country. And of course, that will be more workers, more competition for jobs, and certainly will help to absorb those excess demands for labour at the moment, which are pushing the unemployment rate down. The interesting thing, of course, is I think as we continue, if we continued with this shortage of labour, which we have pushing unemployment rates down, it would start to put upward pressure on incomes. And of course, that's the go signal for the Reserve Bank on interest rates. But with migration, that will certainly ease that type of pressure from job shortages on higher wages. So maybe there's something to consider there. But there were some other interesting points, Michael, if I just might mention them in the population data. Queensland recorded over the year to the September quarter a net interstate migration gain of 40,000 persons, which is quite remarkable. In fact, the September quarter data for net interstate migration, Michael, and that's the difference between those coming into a state and leaving a state, was well over 16,000 over the quarter, which is an all-time record for Queensland in terms of the number of people moving into that state, or the net increase in people moving into Queensland over a quarter. And the levels of migration into Queensland, net migration, while still not at the record levels, are still near record levels. And it's interesting also to look at where the records were previously for Queensland net migration. And the first was in the early noughties, 2003, 2004, which corresponded with a huge exodus out of New South Wales. And of course, we remember those economic issues that affected New South Wales in the early noughties. We had a real exodus of people. And then the record was actually just after the 91 recession, Michael. The record exodus or the record inputs from interstate migrants into Queensland. And that corresponded with a record exodus out of, you guessed it, Victoria at that time. So it is interesting that Queensland is the state of destination when Victoria and New South Wales are under stress. But so there were some big numbers in Queensland. We know that the Brisbane housing market is responding to that. That ABS data reflects that, Michael. ABS recorded a 10.8% increase in the median house price over the December quarter, which is quite remarkable, and of course reflects a lot of that those migration issues. Even though the trends are now declining, Michael, in terms of overall migration, so we've passed the peak of declines in net migration as borders are starting to reopen, but there was actually a net gain for the first time for New South Wales in international migration. And I think that reflects all those expats coming back into New South Wales. And again, that's been a bit of a driver of the Sydney housing markets.
Well, they're obviously looking in the rear vision mirror. And as our borders have started to open, initially visa holders are coming in, migrants are going to start coming, tourists are going to start coming. So it'll be interesting to see how all this translates to affecting our property markets. Last week, the US Federal Reserve joined other central banks in raising interest rates. It reflected the tighter labour market and higher inflation in the United States. But they actually flagged 6 further rate hikes this year alone and the start of quantitative tightening coming soon. Now, not surprisingly, this fueled speculation that back home, the Reserve Bank's also going to have to start raising interest rates. And some are even suggesting in June this year. That's just around the corner. What are your thoughts on that?
No surprise regarding the US, Michael. That's been flagged for some time. If we put it into perspective, the US inflation rate is running at just under 8%, which is the highest level in 40 years. That is a very high inflation rate. Australia's inflation rate is half that of the US. Our incomes growth is also, as we know and have discussed, still benign. And incomes growth in the US is quite strong. They have a different labour market, which reactivates wages in a lot more of a real-time environment than Australia. So things are different in terms of the macro drivers for higher interest rates in the US and Australia. The Reserve Bank has been adamant that we need to see a shift in wages before they will consider higher interest rates. We know that inflation in Australia has been driven by COVID factors such as high price of oil, reflecting supply constraints, and also high building costs for houses, reflecting supply constraints out of COVID stimulus packages. So nothing's really changed, Michael, other than the US have put up rates. It fuels the hysteria around the prospect of higher rates. I would think at the very least the Reserve Bank would be waiting for the next wages data, which I think won't be out before June, and that would be for the March quarter. So if they act, it would be extraordinary without having the data to support it. And they have said they needed to see a consistent period of higher wages, and that would mean above 3% growth. And wages growth now is just at 2.3% annualised. So it would really be a leap of faith from the RBA to raise rates in June. But I think it's interesting, Michael, just on the US quickly, that Powell was having really seemed a little bit, I guess, under pressure in terms of his response to rate rises, and quite clearly said that, yes, there was a possibility that this may end up in a recession. In fact, the odds of a recession, apparently, the market is now increased in the US as a result of rate rises up to 33%. So this is really a high wire act, a balancing act from the Fed Reserve. Particularly if they continue, if it doesn't work, of course, they're committed to continuing, as you said, to raise rates until it does work. And if you can't really impact supply side constraints by significant reductions in demand without slowing down the economy, prepared to do that. But it's a different ballgame there compared to Australia. Our numbers are much better in terms of inflation levels and wages. So I'd suggest the Reserve Bank will stick to its guns and keep rates on hold until, at the very least, we see a couple of quarters of strong wages growth. And
back home in Australia over the weekend, our auction markets resumed. They had some disruptions with floods, unfortunately, and in some states, holidays, long weekends last weekend. And they got back into action again with large numbers of properties being auctioned.
yeah, look, at reasonable results of the market. As you said, Michael, it's been a bit up and down over the last few weeks. Two factors, of course. Last weekend, we had public holidays in Canberra, Melbourne and Adelaide. So the market paused. And in Brisbane and Sydney, they've been suffering from the floods, which were quite catastrophic and certainly had an impact, particularly in terms of withdrawal numbers. No surprise, there were higher numbers of withdrawals in Brisbane and Sydney, and that acted to push down clearance rates. And look, numbers were still high, but of course we know, particularly in Sydney, those numbers would have been booked in prior to the floods. But the flood issue and the holiday distractions have eased. I guess we're working into more of a normalised market environment. All those clearance rates still clearly favour sellers, Michael, in those markets. And we are still seeing high numbers of properties going under the hammer. It's providing more choices for buyers and more competition for sellers in those markets. I think going forward, we are going to see, up until the Easter break, more significant numbers of properties coming into the marketplace. And I would expect to see some easing of clearance rates, but that may be offset, particularly in Brisbane and Sydney, by lower levels of withdrawals.
Well, lots of economic news this week, and clearly our property markets don't work in isolation. All these factors affect consumer confidence, interest rates, and how we feel about our housing markets. So I look forward to catching up with you again next week and seeing what else is going to change.
Thanks, Michael.
Pleasure. Bye.